Hello, welcome back to the channel. So today we are going to be talking about basic terminologies in Forex. So these terms are what you're going to be encountering every now and again as you venture into the Forex market. So if you are coming to the Forex market day in, day out, these are the terms in which you will come in contact with, and it will be nice for you to find your way around it and play around with these terms so that you can be conversant with them. So you'll be asking questions when you come into trade in the Forex market. So let's get right into it. So we have number one, what is Forex? What is Forex? Now Forex, which is FX, stands for the foreign exchange, and it is the largest liquid market in the world. Okay, I have a video already on this specifically for this topic. It's right up here, so you can go and watch and be satisfied with this topic. So for today, it says Forex stands for the foreign exchange, and it is the largest liquid market in the world. Okay, so in Forex we exchange one currency for another for the aim of making profits, and it is the largest liquid market in the world. It's about 7 trillion being traded every day in the Forex market. So we have the currency and pairs. So currency is defined as a medium for exchange. So in Forex trading, what we exchange is currency. So just as you're going to market and what you exchange for goods or for services being rendered is money. So but here you exchange what currencies, different currencies. So our medium for exchange is currency. So for example, here we have the US dollar, we have the euro, and we have the Japanese yen, among other currencies we have in the world. Currency pair. So a currency pair is referred to as a set of two currencies that are to be traded. One is being bought and the other is sold. So example of currency pair, we have the euro USD. So the euro is the base currency, while the USD is the quote currency, and the base currency is always higher than the quote currency. So for trading, we have to combine one currency to another for trading to take place. So just as we have pairs of shoes, now we have pairs of currency. So for you to be able to trade in the Forex market, you have to combine two pairs together. So among other pairs, we have the GBP USD and so many other currency pairs, so many examples of currency pairs. But for this example, we have the euro USD, which is the base currency is the euro and the quote currency is the USD. Okay, so now we have the bid price, ask price, and spread. So what is the bid price? The bid price is the price at which a broker will buy the base currency from you. Okay, so that is the bid price. So you say is the price at which a broker will buy the base currency from you. So if you're selling, you have to do what? Buy it what? From you. So what is ask price? Ask price is the price at which the broker will sell the base currency to you. So if you are going to a store, for example, say, okay, I want to sell this. Okay, I want to buy this. So that's what we're talking about, what the ask and what the big price. But for here now, which is the ask price, is the price at which the broker will sell the base currency to you. So if you want to buy, then you now do what? Sell it to you. So that is the ask and bid price. Now have spread. Now, the spread is the difference between the bid and the ask price. This is essentially the cost of a trade and how a broker makes their profit. Okay, so you might be asking, how do these brokerage companies, how do they make their profits? How do they profit off the market? They profit off spreads. Okay, so for this example, we have, if the euro USD bid is 1.1000 and the ask which they want to sell to you is 1.1002, the spread is what? The 2 pips. Okay, the spread is what? 2 pips, and that is what, how they make their own profits. So for every trading which you take, there's always a spread. Is always a spread for every trade being taken. Okay, I hope you're getting it. Hope you're following too. Now, what is lot? Okay, what is lot? So a lot is a standardized unit of currency volume. It determines the size of your trade and therefore the volume of each pip. Okay, so we have 3 types of lots, lot sizes. We have the standard lot, we have the mini lot, and we have the micro lot. Now, the standard lot, you see, $100,000 units of the base currency. That is the standard lot. Now, the standard lot is from 1 to 100. So a standard lot is from 1 to 100. So if you are taking a trade and you put 1 lot size, that is what a standard lot size, and it's about 100,000 units of the base currency. Okay, so a 1 pip move is worth about $10. So if you're using a 1 lot size, for example, and you taking a trade, and the trade is going your direction in 1 pip, that is, you're making $10. And if you're going your direction in 10 pips, that means you're making what? $100. Okay, now the reverse is the case. If it's going against you in one pip, you're losing what? $10. If it's going against you in 10 pip, you're losing about what? $100. So that's how it works. Okay, now we have the mini lot. Now the mini lot is about 10,000 units of the base currency. Now we have the mini lot is from 0.1 to 0.9. So if you're taking a trade and you're using 0.1, or you're using from 0.1 to 0.9, any of those can be 0.2, 3, 4, 0.5, as the case may be. Okay, that is the mini lot, and a 1 pip move is worth about $1. So if it's going against you, if it's going in your direction, is any pip move, 1 pip move is worth about $1. Okay, so now we have the micro lot. The micro lot is a 1,000 units. A 1,000 units, okay, of the base currency. That is a micro lot, and the micro lot is from 0.01 to 0.09 lot size. So if you're taking a trade and you're using 0.01, know that you're using a micro lot. Okay, now a 1 pip move is worth about $0.1. Okay, so if it's going against you, it's going in your direction, a 1 pip move is worth about $0.1. Okay, so now we have pip. What is a pip? Now, pip stands for points in percentage. Okay, a pip is the smallest unit of price movement in a currency pair. Now, this is how we measure movement in the market in price. Okay, we measure it what? In pip, just as we have other means of measurement in meters and stuff like that. But when it comes to Forex, when it comes to movement in Forex, we measure movement in pip. That's why I said a pip is the smallest unit of price movement in a currency pair. So example, if Euro USD moves from 1.1000 to 1.1001, that is a 1 pip movement. That's how we measure it. It is being price movement is measured in pip. So for this example, it is a 1 pip movement. Now, what is leverage? What is leverage? Leverage is a borrowed capital provided by your broker to allow you to control a much larger position than your account balance would normally allow. Okay, so for this example, with a 1:100 leverage, you can control a 100,000 position with just 1,000 of your own capital. Okay, so you're leveraging off the brokers. So if you have a $1,000 of your own capital, you can be able to control a 100,000 position. So that means you can be able to maximize about $100,000 in the market with just $1,000 of your own capital. So we are using it's like you're using the brokerage. Now you're leveraging off them. So that's why it's called what? A leverage. You're leveraging off your brokers. Now we have margin. What is margin? Margin is the amount of your own capital that is set aside to open and maintain a leveraged trade. Okay, for this example, we have with the 1:100 leverage, your $1,000 is the margin. So let's just say that is the amount you keep down. So okay, so for this position, so for you to be able to control that $100,000, okay, you have to drop something. Okay, you have to drop something. So let's say if you want to go and get probably a car or something, so okay, this is what I want to drop. Okay, in the next few days or so, I'm going to complete it up. So that money you drop is what is your margin. Okay, so for this example, we said with the 1:100 leverage, your $1,000 is your margin, is the money you keep aside. Okay, I hope you're following. Now, what is stop loss? A stop loss order automatically closes a trade when it reaches a predetermined loss level. So as you're taking a trade, you place a stop loss order. So if price gets to that point in price, it's going to close automatically. So even if you're watching the trade, even if you're not there at that point in time, in as much as you place your stop loss order there, it's going to close automatically. Okay, without even asking permission from you, your broker is going to close the trade for you once price gets to that level. Now, what is take profits? Take profits order close a trade when it reaches a predetermined profit level. So as you're taking a trade, you're placing your take profits order. Okay, so that when price gets to this point, you're telling your broker, once price gets to this point, I want you to close the trade for me. Okay, so that is a take profit. So it closes automatically without any prompting from you or asking any further permission from you. So once you've placed it, it closes automatically. So these terms are very, very important, and you have to know them if you're coming into the forex market. So go back to the video and watch it again, take down notes, and if this video has given you value, please like, subscribe for more content. So thank you for watching, and I'll see you in the next video. Thank you.